Good, Owen. How you doing? Good morning to you.
Thank you. And good evening to everyone, or it could be good morning to some folks if you are tuning in like I am from around the other side of the world. I am currently seated in a hotel room in Bath, which is in the United Kingdom, for those folks that haven't been here. And you can bring all the puns you like, but I still haven't actually had a bath since I've been here. But it is a beautiful city. If you can hear us, we would love to hear from you. Just say g'day in the chat. I can see Aisha's already made a comment. I've got comments about different ETFs. Fahad's already made a comment, and we can answer all of those tonight. So thank you to everyone who has joined us. Chances are this may also go out across the Rask podcast. So for anyone that does listen to this back in audio form, please know that there is a live recording happening right now, but by the time you listen to it, it will be after the fact. We're going to try and make it as easy as possible. We won't throw out too many charts or too many things that you won't be able to visualize at least. G'day, Derek. Good to have you, mate. Good to see you. Benny, you too, Winston, and Mike's with about 7 S's after the mic. I like it. G'day. So I do have a few slides, and I've promised Mitchell there won't be too many of them. So I'm just going to bring these up now and hopefully take you through a few things really quickly. For anyone that is watching, you'll be able to see some things on the screen starting about now. So if you can see that, just let me know. G'day, Mike. Good to have you in the chat and joining us tonight, of course, mate. So we've got some things to cover tonight. We'll cover why did we start Rask Invest. We'll take you through everything. We'll show you what we invest in. Mitchell and I, Kate, Monique, the team in Melbourne, we were over at the Australian Shareholders Association event last week, and it was a heap of fun. And one of the things that we did on stage is we showed all of the Rask Invest portfolio for our Terra strategy and all of the ETFs and how they're kind of currently made up. So we'll show you all those different types of things. So if you've come here tonight looking for different ETFs and to see what we actually invest in, that's all on display tonight. And then finally, we'll get some rapid fire Q&A. I've got rapid fire Q&A for Mitchell, and you can have rapid fire Q&A at either of us. So bring the questions, ready them. You can even chuck them in the chat now if you want, but we'll start to answer more of the questions in probably about 15 or 20 minutes.
And if you don't pay attention to any slide other than one, this is the one to pay attention to on your screen right now, our general advice disclaimer.
Yeah, so this is really important because we do get a lot of questions at Rask around investing and these types of things. And many of you know that we do have financial advice partners. So I don't know if you know this, Mitch, but I graduated with a Master's of Financial Planning because one part of me wanted to go into financial planning and the other part of me wanted to stick with being an analyst and investing. And so I graduated with a Master's of Financial Planning and a Master's of Applied Finance. And lo and behold, we've got a business now that is kind of a blend of the two. We like to talk about more than just investing, but at the same time, we are so passionate about investing, which is why we're all here tonight. But what I mean to say is, if you want one-on-one personal advice, you need to speak to a financial planner. While I may be recording in the UK, where the advice laws are even stricter than Australia, Australia has some of the strictest financial services laws in the world. And basically what it means is we can't give you one-on-one advice, even if you pop a question in the chat, which is very reasonable, and we could answer it, like practically speaking. You need to get one-on-one advice. So anything that we do say tonight is strictly general in nature, and we would direct you to our financial services guide, as well as the PDS and TMD for Rask Invest. And also, I'm sure you'll be able to find the Rask Financial Planning page. Okay, so just quickly before we get into the actual meat of tonight's conversation, I thought I'd just share 2 lessons from Europe. Obviously recording here in the UK. And does anyone want to tell me what this is here on the screen? So for those of you that aren't watching, it's a big picture of what looks to be a map. And if you do know what it is, I would love to know what you thought about it if you have experienced this. I'll give you just a couple of seconds because it's actually the Tube map. That's correct. So this is actually a picture of the London Tube. For those of you that aren't familiar, that's the underground rail system here in the UK. And thanks, Sammy. And the subway train line thingo, says Isha. Yes, that's correct. But basically what it shows, for anyone that's not watching, it shows dozens of different train lines all intermingling. And if for anyone that's actually been on the tube, you will know that it's unlike anything we have, at least in Australia. And it's more, it's almost so hard to comprehend because some of the lines were dug, hundreds of years ago. It survived world wars, and it's still there, and it operates on a cadence of about a train every 2 minutes. So if you never see someone run for a train in London, put it that way, because they know that there's one just around the corner. But it reminded me of some of the companies that historically I've liked to invest in, companies that manage extreme complexity and they make it seem so simple. And I think if you're out there investing and you're looking for different companies, aside from the obvious fact that this is obviously a monopoly, there's only one tube in London and the government controls it, which might be like a PEXA for those of you familiar with the business that does the property settlements in Australia. What we should be looking for, if you're looking for individual businesses, we're focusing on ETFs tonight, is looking for companies that handle such complexity and make it seem so simple. And the users just pay a fare, they get on, and they get off. And I think one of the businesses that many people will be familiar with is a company called SAP, or Oracle is another one, that handle a lot of the software at corporations. So that's my first little anecdote. This tube system is incredible, and the businesses like that are also really interesting. The final non-investing thing that I've tried to make investing tonight is something that I stumbled across while at the British Museum, which is the Rosetta Stone. For those of you that don't know, this is a stone that comes from, I guess, what we would call like Northern Africa, or kind of like Egypt now. But basically, this stone was found, hundreds of years ago after it had already been through a few wars. It came from a temple, and it has hieroglyphics on it. And basically, it was used to unravel all the mysteries of what the Egyptians had in writing on temples, on walls, and these types of things. And it's fascinating because they just found this piece. Some British, I think it was the army officers, actually found it, and actually you can see a stamp on the right-hand side of it here. That stamp was actually to say that this has been basically taken by the British Army and was taken back to the British Museum. And they used this to untangle all of the mystery around hieroglyphs. And it was fascinating. And obviously, if you come to Europe, you'll see that things often don't change. And in the first walkthrough that Mitch and I ever did for Rask Invest, it was a few weeks ago now. I think it was the first one, maybe it was the second one, actually, come to think of it. There was a quote that we had from Cicero, which was, to not learn from the past is basically to go through life as a child. And it's a famous quote because it reminds me that if you don't learn from the lessons of the past, a lot of the times what you do in the future will just be repeating the mistakes that others have already made. And I think if we think about investing for the long term, one of the things that won't change is human nature. And I think what we'll see repeat again and again and again in different guises is irrational behavior. So hopefully from tonight, we can bring some calm to that and we can teach you some lessons from the past. Okay, so that's my weird history tour for tonight, Mitch. We are presenting, you and I. What else are we going to talk about tonight other than just stones and underground rail networks?
Yeah, other than the radio. So I didn't know where you were going with any of that. So basically tonight we're going to do a proper walkthrough of the Rask Invest platform for everyone who's come along and that's interested in that service. Owen's got it up on the screen right now. This is a real live account that you're seeing. It's Owen's actual account. And so we're going to go through the actual account that you would see if you were invested with us. We'll go through the different portfolio options that we have, and actually show you all the ETFs that we use. And then of course we want to spend as much time as possible jumping in and answering any questions, taking on board any comments and whatnot. So. Thank you for joining us tonight. And Owen, where do you want to begin, mate?
Sure. So other than weird anecdotes from Europe, what I will say is we have released a few episodes on the podcasts so far over the past couple of weeks. They're also in video form, and we've had some really good feedback to those. If you haven't already caught them, the first episode actually shows you why we invest the way we do invest. The second went into 10 investing truths. And the third was about talking. We talked about the things that we believe no one really wants to talk about in investing, at least not in the professional world. And so if you haven't already taken a look at those, I would highly encourage you to go and check those out. But just in case you didn't, the first episode was all about why we use ETFs for the core of our portfolios. And the feedback that we've received from that discussion was that basically it's like we've just revealed like 10 years of our experience, or in the case of Mitchell's got quite a bit more experience in the investment management world. But we've basically just revealed all of the things that we've come across, whether it's 1,000 podcasts, countless articles, all of the things that we've come across. How do we boil that down into an investment portfolio? So that was really interesting to hear people's feedback to that. The second installment was all about basically like, what are the things that don't change in investing? What are the things that have stayed the same, but maybe have a different flavor to them? And long-term investing, for example, hasn't really changed. It's been around for hundreds of years. Investing in businesses hasn't really changed. It's been around for thousands. And then the third thing was, well, that's all well and good. We can invest in a certain way. We can have these things that we believe, but we still got to pay tax, and we still got to pay costs for investing, in certain things and fees. So how do we manage that? And that's what the third installment was all about. So we're going to try and blend those three things together in this discussion tonight, while also revealing some of the things and answering your questions. G'day, Peter, coming from WA.
I just recall actually having a whinge about how much paperwork the ASX send out.
Oh yeah, that too. Right, like save the trees, opt for email notifications. Yeah. So that's basically a recap of what you've missed. Tonight we're going to talk about a few different things, but maybe to kick things off, we'll start with why Rask Invest exists, because that's what we're all talking about tonight. So I've just got a little slide here, this is basically the last slide of the evening for anyone that's just listening. But so why did we start Rask Invest? Well, basically there are two sides to the Rask business. What most people know us for is the 27,000 students that we've enrolled in our mostly free courses. Maybe you've been to the Rask Media website or the Best ETFs website, and you've got free news and analysis on companies, or you've heard from experts. Or maybe you've been a member and you take all of our ETF and share research and you apply that in your, say, Perla account or your ComSec account or whatever. And so people have known us for this do-it-yourself type mentality, which is still something that we champion and is still something that we will continue to champion for a very, very long time. But what we've realized is that even if we can host an event with 500 people, a lot of the times the people that we are connecting with are not necessarily and not always the people that sit in the room, not the people that pay $40 to come to a Rask event, not the people that listen to a Rask podcast, every week. And frankly, not everyone that is listening to this or watching this tonight, it's not all of us. It's actually the people that are in our friendship groups, that are in our families. And what we sat back and thought is, how do we help those people? How do we help the people that know that investing is really important and want to do it well, but they also want to get on with their life and they're not really as interested? And so what we needed was a way to help people to invest and to do more of the heavy lifting for them. And so that's where the idea for Rask Invest comes from. Instead of a do-it-yourself approach, it's a do it for me or do it with me approach. And I think this is a really important distinction. And that's why we said in the emails over the past few weeks that this is easily the biggest move that we've ever made in our company. And this is really important for everyone to understand, is that we're basically applying all of the knowledge and all of the wisdom and all of that kind of legacy that we have and that goodwill, and trying to turn it into something that is genuinely, we believe, in the best interests of our community. So it's not like a fee grab, because if anyone does the math, you would realize that the fees are really low and we don't make a lot of money for it unless we become, a $10 billion plus investment management company or something wild like that. This is actually just an opportunity to help people invest better for the long term and to help more people. And that's why Rask Invest exists. And to do that, obviously, Mitchell has joined the team. He joined us recently, but he has a depth of experience at these types of things. And we've still got the same analyst team. We've got a new investment committee that sit above me. So it's who I report into when there are portfolio changes and these types of things, and they give me very good feedback. So Rask Invest, in summary, is an opportunity for us to help more people, to help people invest sensibly their core portfolio for the long term, and will continue to serve everyone else in other ways through the do-it-yourself style of the Rask brand, if you will.
Yeah, I've had just today a lot of conversations with people uh, about people who have followed along the Rask podcast and whatnot for a very long time, and they would say, "Well, you have portfolios of ETFs. Why would someone pay a management fee to have a portfolio of ETFs managed that when they could just do it themselves?" And my reply to that is, for every one person who is happy to spend their Wednesday night talking about ETFs on YouTube, there's quite a few more people who know they probably should invest but don't want to dedicate this type of time to getting to the nitty gritty of it, and want to go somewhere where they trust and their friends trust. And so I know we in the podcast we made up the little name of the household or friendship group chief investment officer. And so you're probably the person that your friends come along to, and I've had at least 4 conversations today with people who said, well, actually, yeah, I've probably referred about 20 people to the Rask website and to the Rask podcast, because they know that giving advice to friends, colleagues and family members is one way to a very good way of potentially to lose your friends and family members. So that's why we do it. This way we can continue on heavily with the education side of things, and also and then also help out those people who do want to be hands off. They want to know what's happening, but they want to be hands off. And I think that's maybe a great little segue into looking at the actual account, Owen, so we can show people exactly what they would be seeing, and just how transparent it is. So I think that's one thing that does set us apart from lots of different services. So we'll just grab that up on the screen.
Yep.
Sorry.
Mitch, can I jump in?
Yeah.
Can I answer Mike's question, which is just what you were answering?
Oh, okay. Yeah.
If I was to become an investor with Rask, how would you substantiate the fee structure for a person who is entirely core and not satellite? As Mitch, I'll just add something onto the end of what Mitch just said, Mike. And I would say that I think that a lot of what investing has been historically over the past, say, 50 years, even before we had computers and E-Trade and big investment platforms through a computer screen, a lot of what investing was this kind of like shady quasi-science type thing, where you would call your broker, they would give you some wisdom, and they would tell you to act now, buy, sell, this. And then we moved into this era of, we'll help you by giving you really complicated strategies that will do really well for you, and you'll do better than average. And what we found in that era, and I would just probably say that was like the 90s till now, is that a lot of the finance industry would try and wow you with numbers and statistics and all these types of things, and try and give you complicated strategies that frankly won't work. And ultimately, what it made us feel and think about investing is that investing has to be complicated. You have to be smart to do it. And ultimately, we've created this kind of mechanicalistic feel to investing, insofar as you feel like you need the widgets. You feel like you need the statistics, the ratios, all of these things. But I actually think that investing is an incredibly human type thing that you do. It's an endeavor that requires you to understand yourself more than actual numbers. And I think that if we think about what we are trying to do with the portfolios, is we actually are trying to help people avoid mistakes. We are trying to help people stay on the bandwagon. And we've actually got an owner's manual that's coming up. The draft is done now, but it will basically be done for you. I think it has to go through legal approval, but it would be, say, next week. We'll email it to you, Mike, and everyone that's on the call. But there is one thing in there that Mitch often talks about, which is this idea of the Delbar study that's been going on for about 30 years. And what it shows, Mike, and apology to anyone that has come across this study before, But what it shows is it's a study that's been going for over 30 years, and it tries to track the performance of individual investors in the funds that they invest in. So, for example, if you invest in a Vanguard fund, how would you do relative to the actual fund itself? And what they find is that individual investors significantly underperform even the funds that they're invested in. So basically, what it means is that people are making mistakes. They're jumping out at the top, or jumping in at the top, I should say, and jumping out at the bottom. So at the top, they're saying, oh, this thing's great. Look how good it did last year. Let's jump in now. And then at the bottom, they're thinking, oh, no, this is too scary. Let's get out now. And this is an idea called the behavior gap. It's been around and well established for quite a while. But what this study actually showed in a very quantifiable way is that individual investors typically underperform their managed funds by about 2.8% per year. And so if we think about what Rask is trying to do, Rask is trying to say, how do we build a portfolio to keep you invested, to focus on the good habits, and to not make you feel alone when things go down, and on the upside when things go well, to keep you on the path, keep you dollar cost averaging, or if you're in retirement, make you feel comfortable and make you feel okay that you can withdraw income from your portfolio and provide for your family. So that side of things, and what we've found with that, Mike, is that that's just one element of why I think it's valid. But the other thing is most of the people that we're speaking to don't really have a problem with a very small fee. That's probably what I would say. Graham, you've just asked is the cat part of the Rask group? Yeah,
so he's our CFO, the chief feline officer.
Yeah, he's
on so many calls. He's on so many.
So those of you that don't know, here at the Rask Group, we're a family business, and the cat has made an entrance into Mitchell's video, and that's perfectly fine because he does appear. Mitchell, tell us, does he only appear when the camera is on?
It's exclusively when the camera is on. I was on a phone call this morning, and that was just voice, and no cat at all. As soon as I hung up, I had to jump into a video call, and he was immediately there. I don't know how he knew, but there he was. Now he's happily sitting on my little bag there that I take to work. So
and so that's what it is here at Rask. So I think we should jump on with this screen here in front of us. Tell us what we're seeing, Mitch.
Yeah, absolutely. So this is the Rask Invest dashboard, and you can see here Owen's invested in the the Rask Jupiter portfolio. So many cat comments in the chat now. He's really hijacked this show. This is what you get if you join on YouTube rather than the podcast. The Rask Jupiter account. You can see then the breakdown of the overall asset classes that we've invested in here. So we've got cash, fixed interest / bonds. There's a small amount. I think the property is probably coming from within one of the actual ETFs, so it's broken that out as well. International equities and Australian equities. Now we've got Owen's performance down there as well. So this will track Owen's performance from what he's actually added, hence the grey line, so $20,000. Versus the portfolio value. It's only been a very short period of time, but and you can see we opened the doors to Rask Invest right at the right time for the market to drop about 2%. But a month does not an investment make. And now we can jump in and see the full account holdings as well. So you actually see the exact ETFs, the exact units that we hold in each, and the average purchase price as well. And so you can see, what has actually attributed to that performance. You can then jump in, and we'll maybe just do this really quickly. The transactions, you can see exactly what we buy and when. So you've got a history of that there. You can export these via a CSV file or a PDF. You can set a specific time frame, and away you go. Dividends and interest, so any earnings you've generated, so you can see all the income that Owen's earned. you can see, but most of the ETFs we hold will pay quarterly distributions. You can see AAA there. That's the Beta Shares high interest cash ETF. That actually pays out a quarterly, a monthly distribution.
Monthly.
Now we use that because as you might be familiar with brokerage accounts, there's generally speaking no interest in at call cash account with a broker. So we use AAA for our cash exposure. Even in a high growth portfolio, cash does play a role. Deposits and withdrawals, you can see what you've put in, what you've taken out. It's pretty straightforward. And then fees, very important. We don't want to hide anything. So Owen will be able to see all of the fees that he's been charged, 0.55% per annum on an account. We do have the ability for people with higher balances and who are wholesale / sophisticated investors to lower the rates after a certain milestone. If that is you, if you're listening in, get in contact with us and we can discuss those. But 0.55% per annum is that management fee. So on a $20,000 investment, which is the minimum, what's that about? Works out to be $110 a year. Yeah.
Can I just mention something on that, Mitch? Which is that, and maybe I might just backpedal just a second. So there was a question that came through about, so is Rask Invest a new product? Yes, it is a new product from us. We've partnered with InvestSmart. So InvestSmart provides the technology and we provide all of the investment service, all of that sort of thing over the top of their technology. So the technology has been around for a very long time. It's been very well established. InvestSmart, for those of you that aren't familiar, is a publicly listed company. So you can go in and check their financials. You can make sure it's real. And that was really important to us because InvestSmart, obviously being a publicly listed company, has the most strict obligations for compliance and for reporting. And the team is great indeed. But then what you get when you invest with us is you get the choice of 3 portfolios. There are only 3 to begin with: Terra, Martian, and Jupiter. What you see in front of you with the account holdings is the Jupiter strategy. So this is the highest growth strategy. And this is important to understand because while this one has proven to be very, very popular for our community, it is not the only strategy. There are others. In particular, I will call out this Terra strategy. If I just wait for it to load just for 1 second. The Terra strategy is a 50-50 portfolio. So what most people will be familiar with in retirement, and this is what we designed it for, is for passive income in retirement. And with this strategy, we basically use the same building blocks underneath the surface. So this is a common question that we would get is, what happens if I want to switch between the strategies? Like, let's say I'm a high growth investor and then 5 years from now, I want to switch to a different, more conservative strategy. Well, underneath the surface, because all the building blocks inside the portfolios are the same, we don't have to go and sell everything to then get you into a new strategy. And that's really important for tax reasons, which is one of the things that we talked about in episode number 3 of the recent series. And so effectively, we just change the makeup of that. There will be some selling, no doubt, and then there'll be topping up of something else. And that's basically how we switch. There are some very small changes and differences, but you can see them right here. I wanted to just spend a moment on this and say that this part of the website, which I'm on right now, which is just the Rask Invest website, if you go to invest.rask.com.au and you click on one of the portfolios, if you scroll down and click the asset allocation button, and you can see where the portfolio is invested, the current holdings within that portfolio, and you can see the underlying holdings as well. You can see that there are some bonds from the Commonwealth Government of Australia. There's Rio Tinto shares, there's Telstra shares. You keep going on and on and on. But down the right-hand side, we can see in our Terra portfolio, and I'll read these out. We've got the AAA cash ETF from Beta Shares. We've got the Fidelity. This was another question, which was from, it wasn't from Trent, it was from Fahad. You asked, do we use emerging markets? Yes, we do. This is an active ETF, Fahad, that is in our portfolio currently. That's the FMEX fund. So it looks like an ETF, it barks like an ETF, but it doesn't quack like an ETF. It's slightly different. It's called a managed fund. It just looks like an ETF. People confuse it for that, but you can buy it through a brokerage account just like we can. The IAF bond ETF is Australian government bonds. The IHVV ETF is the S&P 500, so US shares in currency hedged terms. Then we've got the IVV ETF, Australia's second most popular ETF. It's just the S&P 500 again, but unhedged. Then we've got the VAS ETF, Vanguard Australian Shares ETF. I talked about that in a recent email. We've got the VBND ETF, is global bonds. So this is from all around the world, currency hedged as well, of course. And then finally, in our more defensive strategies, our income-focused portfolios, we've got the VHY ETF. So this is one that was really popular with the ASA crowd, Mitch, which is basically just Australian shares filtered for the dividend payers. And it's low cost, it's diversified, it's a good ETF in my opinion. But what I wanted to illustrate for people here with the portfolios, these portfolios have only been in existence not 2 months yet. And what I wanted to illustrate with people is this is effectively a blank canvas. So the reason that we are launching these portfolios now, and one of the things that's really beneficial to everyone watching or listening to this, is that I absolutely hate investment admin. I absolutely hate it. But I think the best time to do the admin and start afresh is a new financial year, i.e. July. So if I was going to invest in a portfolio, a new strategy, I would be thinking about doing that right before the end of the tax year so I can start next year and get things in order. And that's why we wanted to do this now. We wanted to show you these different types of things, and you can see how we're doing it. Whether or not you invest with us, you can still see it here all the time. Now, that's my digression, Mitch. I will now resume back with you. That's the investing side. So please keep your questions coming in. I can see numerous questions about the ETFs. So please keep them coming in. But I'll continue on.
No, it was a good tangent. And now I'll actually jump into a quick question that I've got from Peter on the side here. He says traditional ETFs were cheap. There are many new active ETFs whose fees are as high as managed funds. Where do you stand on these? And I think that's maybe a good segue, because clearly, Peter, we use one. The management fee on FemX is just below 1% per annum. On emerging markets, you do tend to, even in the most passive of emerging market ETFs, you do actually pay substantially more than, say, an S&P 500 ETF. Like, so just to compare fees, IVV, for example, has a management fee of 0.04% per annum, so next to nothing. But on, say, when you're looking at emerging markets, generally speaking, you're above 0.5%. I think I saw one passive one at about almost 0.6% or thereabouts.
Yeah,
I think it was that one that you're showing now, 0.69. That's it. So the Fidelity emerging market ETF that we use, if you're just looking purely at fees there, I think off the top of my head, it's 0.96%. 99, is it right? It's not far off that. To be fair, to get that active management, and in an area where we're happy to pay up for that active management. To have the boots on the ground style research in emerging markets. It's a very small percentage of our portfolio as well. I just got to note it's a very small percentage of the portfolio, so we are mindful overall of the portfolio's total MER, wanting to keep that as low as possible, because we do know that eats away at an investor's return.
Yeah, one of the things that I think we've kind of educated the Rask community on over the past 5 to 10 years is this idea that it's okay to pay fees, but just know what you're paying and what you're getting for those fees. I think if anyone here had a time machine and we went forward 5 years, we would definitely take the more expensive option if it outperformed the cheap option. We just don't know exactly which one those are, but there's some great research around this, particularly for emerging markets, for small cap companies and global small cap investors, I should say. So those 3 buckets, let's take them again. Emerging markets, which might be like China, India, these types of places. Small cap companies in Australia, so small cap fund managers. And global small cap companies, say companies that, in our terms, they would be very big, but say under $20 billion in market cap. That's the total size of the company. If that was an Australian company at $20 billion, we would think that's a big company, but on the world stage, it's actually quite a small company. Now, if you look at those 3 different parts of the market, you've got emerging markets, you've got 2 sets of small caps. one of the reasons I believe that those markets you should consider active funds management is because ETFs haven't done a very good job of replicating those markets because it's not easy to do. There's not always a lot of information on the smaller companies. In places like China, in particular, there's a lot of geopolitical risk, there's a lot of regulatory risk, there's a lot of government intervention. And so having boots on the ground, people who understand that regime, the marketplace, can actually add a lot of value. And so we've shown on the screen two different ETFs. We showed the IEM, Emerging Markets ETF, and I've now got up on the screen the EMKT, the Emerging Markets Multi-Factor ETF from VanEck. So these two are very popular. This one here in front of you, the E-Market ETF, is actually what we call a multi-factor ETF. So this is, if we think about this, what it actually is for everyone, I don't want to get too nerdy, and feel free, that can happen at the end of the show once everyone's already switched off. But just quickly on this is probably these three ETFs, the FMEX ETF, the E-Market ETF from VanEck, and what was the other one, the IEM ETF. These three are probably the top of my list in terms of being really interesting to me, but they're all ETFs that have a high fee. So you've got to firstly get over that hurdle. But the reason that they're interesting is what they do is very different. So this one here is a multi-factor ETF, meaning that it doesn't just select random stocks in China and India and places like this. It actually takes a mathematical approach to finding companies that have high quality and these types of things. It's performed very well in a very short period of time. The FMEX ETF, or managed fund, I should say, is an active strategy. So the Fidelity is actively picking the companies. And thirdly, IM is more passive, but you do pay a high fee for that. So there's plenty to choose from, but I would encourage everyone to explore it. So yes, we can use these. Yes, they're part of the portfolio, but as Mitch said, they're a small part of the portfolio.
And this comes back as well, Owen, to what we're looking for across the board is the best expression. I think that's an important in-house principle to put across to people who are examining this, that how you actually select the ETFs that go into these portfolios is we are looking for the best expression of the asset class and that exposure that we want to invest in, and which you've got here on the investing philosophy page.
Yeah, so we didn't touch on this as much as we probably should have in the videos, but just quickly, a lot of investors and a lot of individuals like us, what we tend to do is we tend to make our mind up on an investment and then just go and purchase it. There's not a lot of feedback through the way we think in terms of, well, we get to the end of the road and then what do? Well, we just keep going. A lot of the investing that we try and establish at Rask is to avoid commitment bias. So commitment bias is this idea that, well, everything should be passive funds, therefore we'll just do everything passive. It's not always the case. What we want to challenge ourselves continuously is what's the best way to invest in the thing that we're trying to invest in. So what I mean by that is, imagine you want long-term growth from your portfolio, as we probably all do. Well, you could invest in individual Australian shares. You could probably invest in property. You could probably invest in private equity. Who knows? Maybe there's even some type of artwork out there that's going to go up in value. But the reality is, not all of them are probably right for the portfolio, but one of them probably is. So what we try and do is we try and find the best expression of what we're trying to do. How do we get to the end of the road in the best way possible? And I hope that makes sense. And for us, it doesn't matter if it's active or passive. It doesn't matter if it's an ETF or a fund. And there are some questions that have come through about the satellites, which we'll get to in a second. But the reality is we just want the best returns. We don't really care where they come from. We just want the best investments. That's all it is. And we try and put in place rules to stop us from committing to things that ordinarily we wouldn't do. So Mitch, a few more things we should go over on the page here. The portfolio action. So when someone's created an account, they funded their portfolio, what are these things down the left?
Absolutely. So the add funds button, I actually need to get that updated, to be fair, because that should just take you straight to your BPay details, because there's no tinkering and whatnot that you need to do. So that's a bit redundant. Your account will get BPay details, and so those details will remain active for the life of your account, and all you need to do is transfer funds in there and you will be invested. Investment preferences is important, so let's get into this, because people of course want to know how they can reinvest their dividends or take the proceeds from their dividends, especially those people who, we've got a lot of them, SMSFs, who are living off the income. So You can set for people growing their account, you can set up a regular contribution plan. That's a direct debit from your bank account every single month. It takes place on the 15th of the month or closest business day thereafter. And it starts at a minimum of $100. You pop that in there and you turn it on, and that'll be automatically drawn from your account. Now, for some people don't know, actually, you can turn on a regular BPay payment. So if the 15th of every month doesn't suit you, you can, via your bank, your online banking, log in and set up a regular BPay payment for whenever you want.
Yeah, that's something that I often do with all of my things. So for my superannuation top-ups, for like heaps of different things, I use BPay. And because we get paid at Rask on the 28th of every month, I know that on the 1st or the 2nd, there'll be money in there, and it just automatically sends money across. So that's how I do it.
So onto the income sweep. So just a quick one with dividend reinvestment. That's the default setting for the Rask portfolio, Rask accounts. The cash will come into the cash component of the portfolio, and then we'll actually deploy that to the underweight positions in the portfolio. So we don't participate in the automatic DRP plans for each of the investments. For those wanting to take the income, you would turn on the income sweep. And that's where every single month we'll look across the accounts with this turned on, and we'll see who has it turned on, see what income they've received over that last month, and then bundle it up and transfer it out to them in one transfer. Of course, as we touched on earlier, the distributions, most of the holdings pay quarterly distributions, and one pays monthly. So each month you'll get that little trickle, and then on the month where the quarter falls, you will get the a much larger sum coming to you. A much lesser used plan is the regular withdrawal plan. However, it's quite handy. So using the regular withdrawal plan, what you do, and this is once again for people, say, in retirement or living off the proceeds of their portfolio, you would type in an amount there that you would actually like drawn down from your account every single month. And this is a good way of if someone's using a total return kind of strategy, they're wanting the dividends reinvested, but they want to use a total return strategy and maintain maintain the balance across their portfolio. This is a potential option for them. Now, you can also do ad hoc withdrawals as well. So I've seen in the past people you could literally have all three turned on. One thing I don't want to see, and I will contact you if I do see this, I will send you a little email just to let you know. It's a little bit redundant having the income sweep turned on and the regular contribution plan turned on. So generally speaking,
so this would be someone putting money in and pulling money out at the same time.
Yeah, well, having the dividends coming out and whatnot. So I'll give you a quick call and we'll say, hey, this is the income sweeps for this, the regular withdrawal, the contribution plans for this, just so you're fully aware, and I'll let you know how you can, if you wanted to.
Not many people do that.
No. That's not a common conversation.
So just to confirm for everyone watching this, what it basically means is you can automate your investments with this. You can also automate by just sending money in with BPay, which is what I do. But then this is for withdrawing the distributions that get paid from the ETFs. They go to your account and then they get paid out to you. And then this one here is for people that want a fixed amount every month. So say they want $1,000, $2,000 a month. They just want to just bang, 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 have that money coming in.
Yeah, and I see Mike's got a quick question there about when do we actually invest it. So when your money comes in, it is done. It's not done first thing in the morning. It's done, and this is a good lesson for ETF investing in general. So with ETFs, of course, you've got a market maker in the background. That market maker does not actually have to be in the market providing liquidity 100% of the day when the ASX is open. So whenever you're transacting in an ETF, you might see at the start of the day prices are a bit funny, or even at the end of the day, the market maker does like to knock off a little bit early and head out the door before 4 o'clock. If you're from a market maker and know why, let me know. I don't know. But you'll see the prices can be a bit funny as the market's opening and the prices across the board are being set. So we wait, and then we do transact early in the morning, say by about 11 a.m. All of our transactions have taken place, but not first thing. And I don't recommend someone does that themselves. If you're jumping in your CommSec account, you might see some strange prices, and you might end up paying $1.10 for $1 worth of assets.
Yeah, it's really interesting to note how ETFs work. And one of the questions that we get is like, is there some sort of risks to that program insofar as ETFs, like ETFs at risk? Like, one of the things that we've heard in the media over the past 2 or 3 years is, was there a bubble in ETFs? And I think that shows, and this is from people that love the attention that the media would give them, like say Michael Burry, the famous short seller who has a different claim every month, or even Peter Lynch, who works for an active fund manager, commenting on ETFs. These things, the way the ETFs work is effectively that when a new investor comes in, more units are purchased and given to that investor. But as ETFs become bigger as an industry, what you'll see is that more investing is swapping between investors, not necessarily relying on all these different third parties. So that's
multiple levels of volume of liquidity. So what you're referring to there is that on market liquidity before it even comes down to the market maker, then well and truly before it even goes into the actual ETF, like having to buy and sell individual stocks.
So for people that might be a bit lost, just the ETFs is a little bit different to when you buy individual shares. A lot of the times you're not just buying from another investor, you're buying from the fund manager in effect. And people have seen that as a form of weakness. Keep in mind, ETFs have been going for decades. They've survived the global financial crisis. They also survived the COVID crash. And all of our ETFs come from highly reputable providers. And the way we pick those ETFs is one of the principles is we have to make sure that we've dotted our I's and crossed our T's in terms of the track record of that ETF, the track record of the ETF provider, confidence in the ETF being around for a long time, and all these types of things. If an ETF was to close, the good news is you would basically just get notified and you'd be given the chance to sell, or we would be given the chance to sell, or they would just send you your money back after they've sold the securities on your behalf. So in terms of what we invest in and the building blocks, we're very comfortable with that for multiple reasons. But it is something that investors should be mindful of, particularly with newer ETFs or ETF providers who are not well established, is what I would say. So Peter, you said, I went to a webinar with an ETF provider where they recommended don't invest in ETFs in the first half hour or last half hour of a day. Yeah, and that's what Mitch was just referring to, Peter. And one of the things about the way that we do it is, so we receive your money when you create an account and you fund the account, and then that it gets through a computer system, all the orders get kind of lined up and everything is checked. But then it goes to a team of, yes, believe it or not, human beings that check everything and then place the orders. And that's really important because if you are in like a quantitative or algorithmic style platform, there will be no checking. It will literally just go, whatever you put in, whatever goes out the door. There's no intelligence around, like Mitch mentioned something before, which is a really salient point that maybe people don't realize, is that, well, hey, Owen and Mitch, I sent $500 today. Does that mean you're going to buy 10 different ETFs and I'm going to incur 10 different lots of brokerage fees? No, we wouldn't do that to you. So we don't make any money from brokerage. You get charged because they're your securities, but we don't make money from that. So there's no incentive for us to overtrade. In fact, there's the opposite incentive. We want to keep as much money in your name as possible. So the way we manage that is, over time, as your portfolio drifts, say, away from the target of what we've set, so say like the growth part of your portfolio grows and the defensive part does its part, what we would do is we would strategically top up with that $500 the things that needed to be topped up. Rather than a lot of trading backwards and forwards, we're always behind the scenes checking everything to make sure that does this actually look like Bob's portfolio, and is Bob's portfolio going where it should be? Well, yes. And so people ask us, like, why did you set $20,000 as the minimum investment? And that's because, one, we wanted to lower fees, but two, we wanted to make sure you have enough diversification when you invest. And you can invest less than that, particularly if you have kids, so you can just let us know. We want to make sure it's accessible as possible. But that's the reason. And that's why it was set. It wasn't just a number that we kind of plucked out of thin air, so to speak.
Yeah, I think, Owen, you've done a pretty good segue there into talking about how we'd rebalance
Mm-hmm.
these portfolios. So it's a really important factor to differentiate ourselves between, say, some other service providers out there. Because there certainly are different other ETF portfolio service providers out there, especially in the robo advice space.
Mm-hmm.
So we are incredibly conscious of that, the fact that there is brokerage costs associated with these portfolios. They're incredibly cheap brokerage costs of $4.40 per transaction, or 0.088% of the transacted value, whichever is the greater of the two. That's passed straight through from the broker, and that's the cost, I guess, of these portfolios being HIN based. So I've got the chief feline officer back here. That would be that's the cost of these portfolios being on your own HIN, and a little bit of additional security for you. So we're incredibly conscious of that, and want to keep all the funds in your account operating to grow your wealth. And so we actually rebalance. We don't rebalance on a set schedule. So you'll notice that there's a lot of people out there that will rebalance once a quarter, and that's what they do. That's what their rules dictate, and away they go, regardless of market movements. Whereas we rebalance as and when the portfolios require it, based on their asset class weights, and that split between defensive and growth assets. So as they've drifted, so that might mean we might not in a normal market environment, say, transact unless you've got cash coming into your account or you're needing to withdraw some. On a model portfolio level, you might, Owen and his investment team might not transact, say, for 12 months. It might not be for 18 months, depending on, and because we're letting the asset classes do their thing. Saying that, though, there could be an instance in an incredibly volatile market where we do transact in shorter succession. So it's just we have trigger points based on weights, not redundant, not time frames.
Yeah. So, Mitch, you know this, but for everyone else's benefit, I was sitting at a cafe. We're doing a lot of walking over here in Europe, and my partner, she's went down and had an afternoon siesta, and I sat in the cafe and started writing an email to everyone on our mailing list, and exactly what you said there, Mike, guardrails. And I started writing this email about the 5 things that no one ever talks about in finance. One of those things is rebalancing. Another of those things is tax. And I started writing this email, and at the top of the email, I said, I'll keep this brief. About 2,500 words later, I thought, I can't send this. This is no longer brief. So we scrapped all of that.
I wanted to see the original draft. I think most people here would. I mean, they're talking about ETFs on the internet at 8:30 on a Wednesday. I think they want to see it.
So I'll give you the crash course on this. Is what Mitch was saying is that a lot of the robo advisors, great, good on them. But a lot of the robo advisors have a formulaic approach in order to keep their costs extremely low. And this is the same for diversified ETFs, by the way, for anyone that invests in a diversified ETF. Basically, what happens is that ETF or that robo advisor has a set of rules that govern how it needs to be operated. And those rules stay in motion until there's a new PDS. So there's a new update, effectively, and you're issued that new document. And so they tend to stay in place forever. And so what we see with those portfolios is that, for example, if you had an ETF, and I'll bring my hand up here and show you that it had 5 different ETFs, and 2 of those ETFs were in bonds. About 3 or 4 years ago, if your portfolio was in bonds, it would have been a horrible, horrible decision. And the reason for that is that when interest rates are at rock bottom, like they were 3 years ago, I know it's hard to imagine with interest rates at over 4%, the government rate, or 6% for your mortgage. I know it's hard to imagine that, yes, just a couple of years ago, they were 1% or below. But if you had a whole portfolio full of bonds at that time and interest rates went up, which they did, your value of your portfolio would have fallen, because not only do stocks typically fall when that happens, but also bonds fall dramatically. And if you take a mechanicalistic approach to your investing and everything you do is written in a spreadsheet and it's bang, here's my algorithm done, what you will find is it doesn't work. And for many of the reasons that I just laid out, if interest rates are zero and they can't go any lower, surely you should be able to move out of that. But no, a lot of them couldn't do that. They were forced to stay in it because that was the rule book that they sung to. Another thing that happens is they automatically rebalance because they think, well, we'll just keep the portfolio in check and it'll be all right. One, that creates a tax event for you if something is being bought and sold constantly. So you are being taxed every time that happens, and you don't know necessarily that it's happening, but it's happening. Number two is oftentimes when that's happening, you're incurring costs, and you don't always know that that's happening on your behalf. And there are many different reasons why that does not necessarily work. So what we do is we take a different approach. We say if the portfolios are out of balance 10%, meaning that the growth side is out of balance 10% with the defensive side, we will look to rebalance. And we will do that strategically. And Mitch was right before that. The analyst team and I, we don't expect to make wholesale changes every 3 months when the investment committee meets up. We expect to maybe make 1 or 2 changes a year, as well as some tinkering here or there. But 1 or 2 changes might be even too much, because we want to make sure after tax that your returns are good. Now, I can't remember the name of the gentleman, but there's a former head of research from Morningstar, which is the big investment firm that researches managed funds, ETFs, all different types of stuff. And he came out and said that the portfolio turnover of an active fund manager is about 63%. What that means in simple terms is that 63% of the investments in a managed fund are changed every year. What that does is you don't know that that's happening, but every time that happens, your tax is being crystallized, because it's not his or her tax that's being filed, it's your taxes. And every time they change the portfolio, there's a buy and a sell, it eventually flows back to you. And now let's take another example. So if the fund manager is changing 60% of his or her portfolio a year, how much is an index fund changing every year? According to the numbers that I have for the Vanguard VAS ETF, the portfolio turnover, i.e. the change in the portfolio, is less than 1% a year. This is really important to understand because it's a benefit of being in an index fund. And you ultimately have a structure where you're taxed less because of the diversification. Now, you're probably thinking, Owen's gone way too far into the weeds on this. But in 5 or 10 years, trust me about this, when everyone wakes up and realizes that tax is a real thing, and it doesn't matter if you own an ETF, a LIC, a share, a property, it doesn't matter. An after-tax return is an after-tax return. People will go, hold on, that guy on that video from ages ago, him and that other bloke, they were talking about this. And basically what it means is a 10% return from one fund manager is not the same as a 10% return from another fund manager, because the taxable amounts could be different. And we are actively trying to not make wholesale changes for that reason. I hope that makes sense. But that's one of the things that no one talks about, but I wanted to talk about in that email. And then I got to the end, I'm like, no one else is going to listen to this, so I'm just going to get rid of it.
And it's something that you can't actually put into the performance numbers when a managed fund posts up their performance numbers. You can't really put that after-tax return up there, because it's one investor's tax rate's different from another investor's tax rate as well. There's a quick question from Marco that I think I might just address. He's asking how liquid, and by the 3 ETFs, I'm presuming it actually means the 3 portfolios. They're incredibly liquid, Marco. We use a lot of the biggest ETFs in the world, like VAS, IVV, etc. And so when it comes for someone to withdraw funds from their individual account with us, you would click on the withdraw funds button, you'd enter the amount, you'd hit submit, and then you'd have to verify it via another via text message or via a email notification, email link. From the day you put the request in, we transact the following day, and you'll get essentially 5 business days for the funds to actually be back in your own bank account. So you're right, you've got the submit the request, you got the following day we transact, so then you got settlement time period, and then an overnight transfer into your own bank account. So the ETFs themselves are highly liquid, but your actual portfolio can be liquidated and cash in your bank account within 5 business days.
But hey, just on that, let's say in 3 or 4 years, you absolutely hate Rask and you decided those guys are schmucks. I am not dealing with them anymore. Please take this advice. If this is the last general advice that you receive, do not just hit withdrawal. Write to us and say, I want you to transfer my investments to XYZ. Like if you want to transfer it to ComSec, whoever you trade with, Self-Wealth, Perla, like those are the 3 most popular in our community. If you go, to hell with those guys, do what's called an in-specie transfer. The reason for that is you can transfer out and there may not be tax consequences. Speak with your accountant, but there shouldn't be tax consequences when you transfer out. And so again, if I go back to the previous rant that I just had, that would be a better outcome. It's called an in-specie transfer.
Yeah, I'll just quickly on that. I'll help you with the paperwork. It's really easy. So essentially with the in-specie transfer, there's been a lot of people who've been following along the Rask core portfolio for a long time, and they've got holdings like VAS, they've got IVV, they've got IHVV. And they actually want to come on board now that there's the option for the Rask team to do it for them, and they don't want to incur the tax capital gains tax consequences of selling down those holdings and starting with cash. If that is you, get in touch with me via the on-site chat or email me, mitchell@rask.com.au. There's a little chat, and 9 times out of 10, I'll say hello very, very quickly on that chat. There's all of Owen's tests. And we can assist with an in-specie transfer into the account to start off with the funding. It doesn't mean we will not sell anything, because, of course, as soon as your account is open, and if you're going to, say, invest in Rask Jupiter, it is our job to make sure your account tracks that Rask Jupiter model exactly. So that means we may have to rebalance slightly across the portfolio, but we wouldn't sell everything and then buy again. So people have been doing that, and they've been funding with combination of cash and shares. If you want to keep specific shares yourself outside, you absolutely can do that. We'll transfer in what you tell us to do.
Yep. I've got one more thing that I want to explain to people before we move into some rapid fire questions. So please chuck them in. I know we've gone a little bit over time, but we're here.
There's one comment in there that's got my attention, and it's not on topic at all.
Okay. Well, we'll come up with we'll come up with that. I think I know the one you're referring to. But just quickly on the screen. So one final thing that we wanted to make really easy for people is when you come down and you click on reports here, we send you the tax report. So every year you can come in here and you can check your tax reporting and you can just hand that to your accountant. Alternatively, we can actually set up a feed directly from whatever your accountant uses, whatever your financial advisor is using, like Iris, or they might use something called like Class. We can actually send the feed.
I don't think we've got a feed for Iris, but we've got Class, we've got Class, BGL, Xplan, Premium.
That's the one I'm thinking of.
A whole heap of them. They are in, and this is another great little feature. There's up near the logout button, there's the help center. There is a list of them in the help center and what you need to do to get your accountant onto that data feed. So the help center is really, really good, by the way. I wrote it myself. It's got a lot of questions in there that we probably we certainly don't have time to cover off. So if you want to do a real deep dive into how everything works, the help center is a really useful little place to go.
Yeah. A lot of our community instead use ShareSite. So anyone can use ShareSite or Navexa. Those are two pieces of accounting software. We won't call it, but they're like accounting software. Basically, what you can do, even if you don't use us, ladies and gents, you can still use the software and just plug it in to your brokerage account effectively. And it can track your tax and your performance reporting. That's really important. I encourage everyone to do that regardless of no matter what you invest in, use it. It saves so much time. But we can also send, because with Rask Invest, you own all of the ETFs and all the individual investments inside, not us, they're yours. We can send the notes to those platforms as well, so that you can see the performance over there if that's what you want to do as well. And you can see all the fees and you can do all that stuff over there too. So you can do all that over there. Now, Mitch, can we get into some rapid fire Q&A?
Yeah, absolutely.
I do have some questions for you, and then everyone can just blast us with a few and we won't waffle as much. So I'm going to ask for less than 30. I've got a list of questions here. Please, answers no longer than 30 seconds. And this relates to the question that we just got from Vince, which is, what are the fees? Can you explain them to me?
0.55% per annum. That's the management fee. There are brokerage costs associated of $4.40 per transaction, or 0.08% of the transacted value, whichever is greater of the two. And of course, being absolutely fully transparent, there are also underlying fees within the ETFs we use. So you would pay those fees regardless of if you invested in the ETFs with us or through your own Perla or ComSec account or Self-Wealth account. But this was probably over 30 seconds, but I think I got there.
Cool. That's a good answer. So just so you can, when you go to the website, I'll put the link in the show notes. I'll put it in the chat here. When you go to the website and you see one of our portfolios, it says 0.55%, that goes to us, but then there's fees for the ETF, which you will pay anyway, but you'll notice that they're very low. And we say the total fee there, right? People get confused about this because we are so explicit about what the fee is. Most of our peers will not be as clear. I'll just say it that way. Will not be as clear about what it is. And there are reasons that they may or may not be clear about what it is that their underlying fee is. All right, next question for you is, can I have more than one portfolio in my account? So
No.
could I open it? No?
Do you want me to explain, or can I just?
Yeah, go for it. You got 30 seconds.
We've found that the absolutely best performing accounts have one portfolio in them. If you think, hey, I'll invest in all three to get more diversification, you are not getting more diversification. You're getting more of the same ETFs. So you're actually not getting more adequate diversification. There are the odd times when it might be suitable for someone, depending on like if you're doing specific strategies. You would, in that case, actually open two accounts in the one name. Just keep them separate, nice, clean, neat. That way you know exactly how each are performing.
But you can, for example, Mitch, you could go down into investment applications. So I've got my own account here. I could then click here to start a new one.
Yes.
And then I could select, say, like if I had an SMSF or something like that, I could have the SMSF in a different strategy or the same one, right? Like I could have a kids account, a company account.
Exactly. And there was a question in the in the comments there about, can you invest for children? Yes, you can have an account as yourself or the guardian as trustee for the child. If you have multiple children, though, it is one account per child. So yeah. Now, if you do have as well multiple accounts, like you've got a personal account, a joint account, an SMSF, a family trust, etc., and there are investors who do have this with us. It would be the one login to the Rask platform, and you then would toggle between. So you'd get an individual dashboard for each of them, where Owen's name is up in the corner there. That would actually be a drop-down list of all the different entities that you invest in, and you can just scroll through them.
Yep, sure. There's a good question here from Peter, which comes in and says, does Rask only invest in ETFs, or do you have other investment options like direct ASX shares? So Peter, one of the things that we are going to roll out is an ability for people to effectively tweak the portfolio. So they'll be able to, for example, say, I want more, because we're core and satellite investors, right? And we provide research on people's satellites, and we talk about all different types of ETFs, not just the ones we invest in. People might want to have some discretion in how they do that. So we want to give that flexibility. In the future, you'll be able to tweak the portfolio, but that will probably still go towards ETFs as a primary role. So think of me and the analyst team as kind of like the gatekeepers. We'll say there are some really high quality ETFs out there or different strategies. Here's a menu, if you like, and go and look at these. It's a fair question to ask, but what we find is that a lot of people still want to DIY some part of their satellite in a brokerage account. And the three most popular brokerage accounts in our network are CommSec, Pearler, and Southwealth. I hope that helps.
There was a question a long time ago, but it's a good time to talk about it, about will Rask be offering satellite components, and how many and whatnot. So in the future, we do plan on doing that. These portfolios are a month and a half old, so we'll get these bedded down and because we think these really lay the foundation for someone's portfolio. But in time, we will look to bring on board potential future satellite components, but that will be driven by what our community want. Really, we do have a community forum, which I presume if you're here having a look at this, you probably are aware of that. The community forum is fantastic, and we will, be consulting the community forum to when it comes to the creation of those.
Yeah, we had some great comments about, like, you can just see all the stuff in front of you here, like all of the different topics. So
it's just in the last 4 days.
Yeah, that's why I've got all these notifications, because I've been walking around Bath looking at all of the architecture and not looking at my investment notifications. But I did see today that interest rates, it looks like expectations shifted dramatically. That's one thing that I do look at almost every single day. It looks like interest rates have shifted on the latest inflation printing. So basically what that means is anyone that has government bonds in their portfolio will have seen that their government bond portfolios, their ETFs, have fallen today very modestly. That's because a lot of the adjustment happened last month. People realized, hey, maybe interest rates aren't going to fall this year. I know that's bad news for anyone that has a mortgage like myself. But basically what it means is that the investors as a whole don't actually expect interest rates in Australia to fall this year. A very, very small chance they might. But previously, if you ask someone on January 1st, they would have said yes, there would be 2 interest rate cuts. So that's a little anecdote. But jump into the community, because these are the types of things that we're discussing. And we share everything with you. So one of the things that we had from one of our earliest investors who's followed Rask for a very long time, he was a member. Full disclosure, I still own Pro Medicus shares myself. So talking my own book here. But for example, a company like Pro Medicus is a wonderful business. We still love talking about individual companies. I made the crude analogy of the London transport system to an ERP business, a software business. I love those types of businesses and I love to invest in them. So just because we have core portfolios here does not mean that we think you shouldn't do that over there. I think that's actually a mistake. I think if you think that there's only one way to invest, there's only index funds, there's only property, there's only this, I think you just shut yourself off to too many things in the world and too many possibilities. So I would say try and avoid that way of thinking, particularly with investing. So Mitch, 2 more real quick questions for you.
I thought we'd finish the rapid fire, but let's
okay. I'm going to give you 2 more really quick. Is Rask Invest a HIN model?
Yes.
Okay, explain HIN real quick.
I was really getting into the rapid fire. A HIN model is where you are the full legal owner in the eyes of the ASX and their CHESS system. HIN stands for Holder Identification Number. So, all right, I'm going to cheat here and go over the 30 seconds because it's a really funny story, and I think he's online. I did have a Rask Invest investor who wants to significantly top up his account. Started with a nice amount, but wants to top up a bit more. And he spoke to his accountant about it, and his accountant said, "Mate, first get your HIN off them, log into the share registries, so Computer Share and Link Market Services, and just ensure that your super fund is the actual full legal owner of these before you go and give a whole chunk of cash to some bloke you watch on YouTube." And that is fantastic advice. Any person that you watch on YouTube, absolutely do some digging. And I was speaking with someone else this afternoon, and you go through our PDS, you can see our service providers. Feel free to contact them and say, hey, Can you please clarify or classify that you work with the Rask Group?
Yep, cool.
Do
So
your own due diligence, because no one cares more about your money than you.
I've seen some horrible things happening on social media lately with finance. I think it's getting out of control, to be honest. I actually think I'm going to write about it in the next 2 weeks. I actually think that there's some really challenging things for the finance industry to contend with on social media, particularly around advertising financial products and the scams that are happening. We had someone, I think it was Wadsey on the Australian Finance podcast recently. She's basically set herself up to be a scam fighter in Australia. She's like one of the top scam fighters, and she just goes around and tries to find all the scams, and they are exploding. Investment scams are exploding. One of the things that we do is everything that you own is on a HIN. So what that basically means is all the investments are yours. That's why if you ever wanted to move in the future, it's pretty easy for you to move. It's also why you can go and check. You can check in the share registry, as Mitch just said. That basically means that it's connected directly to the ASX. So the ASX would have to have a full meltdown in order for anyone to lose that number. And that's obviously not going to happen because we don't want that to happen as a government. So what I mean to say is we chose that model. It's very secure. It is the highest standard of security. There are cheaper models around, but they don't offer that same level of security and peace of mind. Okay, final thing is, do I get a tax statement? Do you bundle that up for me? Do I get a tax statement that I can hand to my accountant?
Yes, we will email that to you. So just read on the tax statements. You will. We need to wait for the ETFs. So the underlying ETFs will will send out a tax statement to us. That'll break down the composition of the distributions that they pay. So we're getting a bit into it here. So essentially, break out the split between because the distributions are made up of income and realized capital gains. So it'll tell us what the breakdown of that is. Once we have all of those, we can then collate them, and we send out one singular statement to you in an email. You can just click forward, send to your accountant.
Yep. Okay, so for folks that don't know, ETFs, of course, you still get franking credits. So that's one of the things that will appear on that statement is franking credits. You also get like foreign tax offsets, all types of weird and wonderful things you didn't even know existed, but you happen to have them. Those things that's admin that needs to be done. And the way that we do that is very sophisticated, and behind the scenes, it crunches it all together and you get that. But you do need to wait a couple of months. That's the unfortunate reality of investing in any way, really, is that you need to wait for the tax statements to be produced. So that does take a little while. So now we can get into some of these questions. Aisha says, I look at HIN like a coat hanger you hang your ETFs on with any broker. I like that analogy. Thank you for that. There was one from Tuni earlier on, which is the one I think that got you a giggle. Tuni, a serial listener and viewer of podcasts over the years, also comes to the, I won't say which event, but he did come to an event last year, and we will be doing these again. Absolutely wonderful fellow. He said, been listening to the mini series and then logged on today, and I have to say, Mitch looks exactly like he sounds like he would.
I presume I'm going to take that as a comment. He's clearly listening to me and thinking that guy sounds like a good-looking rooster.
Another question came through from Vince. Mitch, I'll bring it up on screen, which was, are the management fees different for larger balances? While 0.55% on smaller balances is modest, on larger balances, the actual dollar figure becomes significant. Good question, Vince.
Yeah, it's a good question. We legally can discount fees for wholesale/sophisticated investors. So if you're investing over $500,000 or more, we can decrease the fees. So please get in touch with me, mitchell@rask.com.au, or use the chat, and I can present those figures to you.
Yeah, so one of the things that is really important, if you don't want to ask a question here publicly for whatever reason, there's probably heaps, just jump in here and pop because this is just on the Rask website. You don't need to be logged in to do this. You just pop your info in here and ask the question that you want to ask, because we, both Mitch and I, have direct access to that, and we are the two that respond. So you can do that any time of the day or night at the moment because we're in different time zones, and one of us will respond. And you can book a call as well. If you want to book a call, you can do all that sort of stuff.
Yeah, and don't feel like you need to wait online for an answer either, because if say use that service at midnight and Owen's doing whatever he's doing over there in Bath and I'm asleep, I will reply to you first thing in the morning and it'll come to you as an email. So don't think you have to wait online.
Yeah, it will. Yeah, and either of us can jump in if there's something that we both can add. The tax statement with the Rask team may well be cheaper fee-wise than separate reporting via the other platforms, says Mike. And yeah, so Mike, I'll tell you something that's really interesting about our fee structure is someone can invest the minimum with us and get access to all of our research. We didn't say, but if you invest with us, you get access to all of the courses that we've ever offered, and you and your family get them for free. You also get access to all of our events that we run every year for free. And who knows, you may actually get some merch and these types of things when you come to those events, which is pretty normal.
You have to work here to get the merch, don't you? It took me years to get this and had to change jobs.
Well, the thing is, like, we when we set up Rask, we were courted for quite a few years, Mike, about whether or not we should launch something like Rask Invest. And for years I said no. I said, how do we do it? How do we do it effectively for our communities, and offer a product and a service that people actually want? And over time, I made a joke many years ago to the team. I said, if you think about the investments industry, the index funds should be more expensive than the active funds because they seem to do better than the active funds. But what I realized is that's not what actually people want. People want the safety. They want the feeling of that their financial future is managed for them. They want an expert to say, you're doing the right thing in a way, or they want someone to do it for them while also having input and feeling like their thoughts are valid and absolutely. And what I wanted to do when we thought about the concept of Rask Invest is we wanted to make it more valuable, not necessarily cheap. We don't want to be cheap. That's not the Rask brand anyway, but we want to be valuable. And if you think about it, if you invested the minimum, not saying you, Mike, just in general, if anyone invested the minimum amount with us, they would effectively get all of the research, all of the courses, all of the events for way cheaper than the cost of our actual membership. And as well as all the other things that come with that. So the community, that sense of belonging and everything. So yes, you're onto something there, mate. And it's not just what you say, it goes deeper than that. Maybe next week, maybe next month, Mitch, or because we were going to do that thing for the community. Sorry, guys, I was thinking out loud here. If people comment in the community, they can maybe win some prizes. Maybe some of the prizes could be merch.
Absolutely. I've got a few beanies lying around.
Yeah.
I want to answer just a couple of quick questions that are in the Peter. Sure. Peter's got a good one about if it's chess, does that mean that there's no partial buys like a custodial model? And so yeah, that's correct, Peter. So what you're referring to there is fractional investing, where you can buy 2.6 units of an ETF. Because it's chess, there is no fractional investing. That's right.
Yeah.
I actually haven't. There's another question here on would we consider a portfolio without bonds and cash? Yes. So perhaps like an all growth portfolio, as we've seen some ETF providers bring out. This is actually, I was having a conversation about this the other day, and with you being in the UK, I actually hadn't had a chance to bring it up to you yet, but I think that is a consideration. That's something that we discuss with the investment committee.
Yeah, absolutely. So would we do a portfolio without bonds? Absolutely, because some people don't need bonds or want bonds, and they might want to hold cash instead of bonds because they're more comfortable with that. But also, one of the things that we are looking at for everyone's benefit is the minimum investment that we say, and thank you, Mike, for filling this in, is 20,000. That's the minimum recommended investment. If you go to our website, that's what it will say. We can take investments down to $10,000, particularly for kids' accounts and those types of things. We are more than willing to do that. You might be wondering, well, what is the rationale behind that? And the rationale is that we want to make sure you're diversified and the fees are minimized. But one of the things that we've realized, particularly with kids' accounts, is that a lot of the times parents and grandparents don't have $10,000 or $20,000 lying around. Let's be honest. But if we had a strategy that was even simpler, so it didn't have the full range of diversification across credit, government bonds, cash, and it just had shares, we could do that and we could have an option. And we've already joked about this behind the scenes. So all of our portfolios are named Terra, Martian, and Jupiter. Terra being about sustainable returns and living off what you've got. Martian's a little bit further out. You're getting a little bit of growth. It's a little bit further away. And then finally, Jupiter's all about high growth and long-term perspective. But if we had something called Luna, like a smaller portfolio that just is off to the side and is just for the kids or a kid, we could do that and we wouldn't have to shovel in bonds and cash for those portfolios. Because for kids, if you have a kids account, anyone listening to this or everyone, for my benefit as well, when I invested for my younger sister, I didn't have bonds in there. So that is something that we can do. And what it means is when we have an investment into something simpler, the money doesn't need to be spread across as many different investments inside the portfolio. So therefore, the minimum may be actually able to come down in time for that particular portfolio. But that's something that we're still working through. So we are still wanting to iron that out and make sure that that's something that we can offer in the future. But the basic gist is, everyone, that if we can get enough conviction that people actually want this and those types of things, we will find a way to solve that problem, just in the way that we already have. So, and we've been doing for years. So I hope that makes sense. Do you guys, Troy, you said, do you guys offer a portfolio assessment? I have more than 70 holdings in my portfolio and a heap of losers through COVID. Troy, you are not alone. We hear stories like this all of the time. And I've learned my lesson. I'm happy to sell the losers for an ETF strategy. Troy, on the website, you can book in a free 30-minute call with Mitchell. A lot of people are doing that. I don't want to put him under the pump too much, but if you go to the website, I'll log out of my account. If you go to the website, this is what you'd see. You'd see a photo of some fellow up the top here, and we'll wait for it to appear. But a little widget will appear in the bottom corner. Just click that. You can get in contact with the team there, or you can, if you want to jump straight to it, book a call
button. Yeah,
at the top here. So I can paste this in the chat now, and just pop that in there now. So that's in the chat for anyone that's interested. You can book a call right there, find a time that works. Troy, as I said at the top of the show, you may have missed this, mate, so apologies, but we have a lot of people that are in a similar situation in terms of people that have kind of like a bit of a medley soup of different investments. I have myself, I spoke about this on a podcast. I think maybe it was the one that you and I did, Mitch. I've had 3 big cleanouts of my portfolio over time. Some of the investments have stayed, but as my investing process and philosophy has shifted over more than a decade, I've actually made pretty substantial changes from time to time. And what I've found is that over time, it's got simpler and simpler and simpler. And if we come back to the very top of today's recording, being able to take something that seems very complex and make it simple is a wonderful skill. And I think as you invest longer and you get more runs on the board, you begin to realize that, you don't need to overcomplicate things. You don't need to have all that in your life. You can keep the admin simple. You can automate. You can use diversified strategies. And sure, it might not be as exciting from one day to the next, but it works. And at least that's what we've seen from a lot of the history that I've been studying. So all shares should be called Mercury, surely, hot and fast, says Peter. Well, yeah, but Mercury is also I think if you're leaving Earth, you probably don't want to go towards the sun, and you don't want to go that close, Peter, if I'm being honest. As they say, you might be flying too close to the sun. Matthew said, why VAS and not A200 for Australian shares exposure? Slightly higher fees.
Question.
So it is a good question. So Matthew, we do get a lot of questions like this in terms of like, why did we choose one ETF over another? I'm going to share something on my screen here really quickly. I'm just going to bring up our owner's manual, which will be out soon. I think I've got it in here. It may be on our philosophy page. Okay, so see this very simple page here, Matthew. What a lot of research has showed us, and what the industry has known for a few decades now, but this is often a challenged point in academia because people don't want us to know about it. Is it doesn't so much matter which ETF you choose to fill a part of your portfolio. What matters is actually having that part in your portfolio. So what I mean by that is, if we go CFA Institute, I'm going to bring this up so you know I'm not telling porkies. 90% SA. So in this report here, this is from a few years ago, and it dives into some of the learnings around this idea, which I'm about to tell you. So there was a study that came out many, many years ago that showed that around 90% of the return an investor gets from his or her portfolio actually comes from just having the big core building block of I'm going to put 90% in growth and 10% defensive, or 50-50, or whatever it is. That's what matters. But the whole finance industry has tried to make us think that that doesn't matter. What matters is which ETF or which stock we pick. But statistically speaking, and based on all of the research that I've come across, that matters not nearly as much as actually just having the position in your portfolio. So what I mean by this is, instead of everyone worrying about which brokerage account, just get started. Instead of worrying about which Australian shares ETF, just pick one. Because the time that it takes everyone to get analysis paralysis is just, it actually reduces your return significantly. And secondly, the benefit is actually just being invested. And I'll tell you why we chose VAS very specifically to that point. So we are building these portfolios for, I think, 10 to 20 years. I think both ETFs are wonderful. With the VAS ETF, you get ASX 300, not ASX 200. The ASX 300 has slightly very, very, very slightly underperformed the ASX 200. And one of the things that I think about if we're investing for 20 or 30 years is we want, one, a lot of diversification, two, low fees, but also a lot of our investors who start today are going to be holding an investment that they're going to keep contributing to again and again and again and again and again over a decade or two. And at the end of that decade or two, what's going to have the lower fees? VAS or A200? I'm willing to bet that Vanguard's fees keep dropping on the VAS ETF. So not only do we get the ASX 300, which is kind of the exposure that I wanted, but also when our portfolios are the biggest and when we've got a taxable gain that we can't shake, we will have hopefully an ETF with the lowest fee. So I hope that is a roundabout way of answering that question. Very long-winded answer to that question, sorry. Mitch, we've probably got time for a couple more. Did you want to pick?
Can you? I'll throw this one at you, Owen. Cam says, simply because it's right in front of me, with the high interest returns so high at the moment, are bonds relevant as a defensive asset class?
Yeah, that's a good question. So in our portfolios, we use primarily two ETFs, which is VBND, which is a global bond ETF, and IAF, which is the Australian bonds ETF. So I think the thing there to understand is they're both government bond ETFs, and they both yield between, say, 3.5% and 4.5%. The difference between a bond ETF and a cash ETF, or just cash in the bank account, is that the cash doesn't change. What that means is if interest rates go up or down tomorrow, as in from the RBA, your term deposit won't change. But a government bond most likely would, like the ETF would fluctuate up or down. One of the things, therefore, that you will have is that over time, the bond ETF will either rise or fall or stay flat, but it will most likely do the rising or the falling, one of those two things. And over the long term, government bonds have outperformed cash modestly. But one of the things that's happening right now, and this is for everyone's benefit, is that even though we're talking about inflation being sticky and maybe interest rates are going to stay high, if interest rates do eventually come down, like let's say we are going into a recession or something like that and the government gets spooked, interest rates will drop. Typically what happens at that time is stocks also drop. So if stocks drop, because we're entering a shaky patch, typically what will happen is interest rates go down and bonds go up. That gives us purchasing power in the future to then buy more shares when shares are cheaper. So is the bond market relevant? Yes. And what are you getting that's different to shares? You're getting that potential for the investment to go up, as well as getting the interest. If you go back 3 years, all of those things were the opposite. So you could invest in shares and you would get a decent return. Interest rates were at rock bottoms. They couldn't go any lower. So that's bad for bonds. And number 3, you weren't getting any income from bonds. So there was really no reason to have them in a portfolio. But now, at least 2 of those things are looking really good, which is that interest rates are high, so you're getting an income. And there's a prospect that interest rates could fall in the future, which gives the bonds a chance to go up as well. So that's just on that. And then obviously when we say these types of things, it's not all or nothing. Please don't take it as all or nothing. There are things between cash and bonds and things between bonds and shares that you should be aware of. We had a great question earlier on about the differences between the sub-D ETF and the FLOT ETF from Van Eck. They're what we call credit ETFs. So they sit somewhere between shares and bonds. So they kind of behave like bonds and they pay an income like bonds, but they also kind of behave a little bit like shares. And so there's many different things that you can invest in. It's not just cash or bonds or shares, but I hope that answers the question.
I just want to bring up something quickly, and this is something me and you spoke off camera about earlier, and it's come up in a couple of questions. Some people may know that the various Rask podcast networks are sponsored by ETF providers, Beta Shares and Global X predominantly. And so I have had questions about are we under any, say, pressure or whatnot to include, specific ETFs and whatnot into the portfolio. So I think it's definitely, it's not a question that's come up here, but I think it's an important point to bring up.
Yeah, sure. And thanks, Mitch. That's a hard question for most people. Probably wouldn't want to answer a question like that, but anyone can throw any question at us at any time. So the main way the Rask Group butters its bread financially is through advertising. Many people know that most of our courses are free. Many people also know that before we allowed advertising on the Rask network. Before that, we had membership subscriptions, and they were a big part of our business. About 2 or 3 years ago now, we made a move at the Rask Group to move away from stock picking investment newsletters as a way to predominantly grow our business. And what people probably don't know is, I don't know the exact figure, but that would have had to have cost us between $500,000 and $1 million to make that change. That was a huge change that we made, and it came down predominantly because my philosophy towards investing needed to change. If Rask was going to stand for something over the next few decades, and we were actually going to have an impact on people, we needed to do something that was always, majority of the time, in their best interest. So building the core portfolios and shifting away from individual stocks. Everyone watching this, everyone that has ever attended an investing event will know how exciting it is to hear about the latest innovation of AI or cannabis or cryptocurrency and all of those types of things. They're sexy, they sell, it sounds great, and everyone's willing to just hand over fist, here's some money. But it's not, in my opinion, the most impactful way that we can help people. And so a few years ago, we made the decision that we would still do share research, but we wouldn't do buy, hold, sell recommendations in the way that we did them historically. You still get share research when you become a Rask Invest investor, or if you're a Rask core member, you still get that. You can log in, you can see reports from myself, Kevin, or the team. You can see them. So a few years ago, we shifted to advertising, and people will know we have some long-term sponsors on our shows. We have Perla, Global X. Global X bought ETF securities. So previously it was ETF securities. Beta Shares. Pocket Smith is about to come on, which is a great thing. We've got, I'm going to get in trouble here for missing them all. But needless to say, we've got numerous sponsors. InvestSmart's actually even one of them. So we've had long established partnerships for advertising. And the way that we've always done them is we've always pushed people, and when I say people, I mean the ETF providers and the sponsors and the advertisers, to 12-month contracts. Because I believe that a fixed price set in advance for the long term is the most transparent way for us to grow our business. And it enables us to offer things for free. Now, in terms of what impact does that have on our portfolios? Absolutely nothing. Because if you look at our portfolios, you will see the makeup of them and you will be able to judge for yourself. And there is no influence at all. We don't actually deal with the investing side of the ETF providers. We deal with the marketing teams because they're the ones that just want to advertise on our network, and they're just advertisements on our network. It's like anything else. Yeah, and over time, I think the final thing that I'll mention here, Mitch, is that over time, I wouldn't be surprised to see that as we get bigger and bigger, not just in Rask Invest, but generally speaking, that they make up a smaller and smaller and smaller part of the pie. And that's already happening. You know this because you oversee a lot of that, but that's already happening. So no influence. That's how we monetize our business. And I think it's very, very transparent. I hope that answers the question.
I think as well, we can definitely put on, say, the monthly, quarterly reports, a note to say who is of that. And as you actually said off air, it's actually had an inverse effect, because we actually there's only one ETF that is held currently via a sponsor. The rest are not.
Yeah, so the only ETF that we currently hold, I've checked this before, the only ETF that we currently hold that is from one of our partners is the AAA ETF from BetaShares. But it does not to say that we wouldn't invest in any others. We could invest in any of the ETFs, and no one's going to tell us, other than our compliance and our legal overlords, no one's going to tell us what we can and can't invest in that respect. Absolutely not. And so I think that's a really important point. One of the things that people probably don't realize is when you go see a financial advisor, a lot of the time, the investments that you get recommended are not always what the advisor would want to recommend. And I mean this sincerely. I love the role financial advisors play, but they don't have enough time to go and research everything. So what they do is they rely on some other type of research provider. And that's what they call an APL, an approved product list. So they're only allowed to recommend investments from this list. And with us, we don't have that. We are allowed to invest in whatever our team researches, and we can prove to our investment committee is of investment merit and safe and secure and those types of things. And I think that that's, of course, I'd say this, you're asking the barber if you need a haircut. I think that that's the best way to do investing, and to rely on an expert. That's the way you want it to be done.
Good answer. We have been going by my clock for an hour and almost 43 minutes. Should we wrap it up and let everyone get on with their evening?
Yes. And I would say that you can ask us any questions you like in the community. It's free. It's open 24/7, and there are dozens of different people in there answering questions, and it's been wonderful. So we are rebooting the Rask Live show in July. So in just over a month, you will start to see weekly live shows as well. So be sure to come back and tune in for that. And obviously, Mitch and I are on standby anytime you like.
My calendar was absolutely jam full with phone calls today with Rask investors and Rask Invest potential investors. So make use of that button to book a call. I'm really, really happy to set aside time and have a good chat. And video call or phone call, a cat or no cat.
Yeah. Mitch, I do want to apologize. I didn't realize we had been going for so long. So I do appreciate you taking some time out.
That's all good. You're on your holiday, mate. You've got to get out there in the English countryside.
No, I do too. We've got a tour booked in just a moment. So I do appreciate everyone else also joining us late on a Wednesday night. I know investing for a lot of you is something that you're truly passionate about, but I do really appreciate your support, and we just love to hear from you. So if you do have any feedback for us, we've already taken on board a lot of feedback that people have given us. If Rask Invest isn't right for you right now, that's okay too. We'll be here when it is. And please go and read the product disclosure statement and TMD that's available on the Rask Invest website. That's as far as I'm concerned, required reading, or at least book a call and learn about the products. Do not invest with us if you do not understand what you're doing. That is not a good idea.
Don't lie on the application form, because you have to tick the box to say that you've read the PDS. So Rask Invest community are not liars. I know that.
Yeah, that's right. And if you need help from a financial advisor, go and get that. They are worth their weight in gold, and I genuinely believe that. And so you can make sure your financial advisor has the AFSL, but check them out if you need that type of help too. Well, Mitch, this has been heaps of fun. Thank you, everyone, for the questions, and apologies if it was a bit scattered tonight, but we will be here. We can answer your questions at any time, so let us know what those are. And Mitch, absolute pleasure, mate. Thanks for joining me.
Cheers, Owen. I'll catch you soon, mate.
Thanks.